Hello everyone, I am Pankaj Bhatia. I am the founder of EduFin and your mentor for the day. Welcome back. Today we'll be covering another interesting topic, the basics of working capital, various components, how to calculate working capital, how it ensures that working capital ratios are well in control. At EduFin, we are driven by a passion for sharing knowledge in the field of banking and finance. Let's deep dive and explore the world of banking together. Let's understand what is working capital. Working capital is the difference between a company's current assets such as cash, accounts receivable, short-term investments, raw material and finished goods, and current liabilities include accounts payable and debts. It is a commonly used measurement practice to understand the short-term health of a company. Before we dive in further, a few points to remember. Working capital is a measure of company's liquidity and short-term financial health. A company has negative working capital if its ratio of current assets to liabilities is less than 1, or if it has more current liabilities than current assets. Positive working capital indicates that a company can fund its current operation and invest in future activities and growth. High working capital is not always a good thing. It indicates that the business has too much inventory, or they are not investing its excess cash, or they are not capitalizing on the business opportunities available. Now let's understand how to calculate working capital. Formula for calculating working capital is current assets minus current liabilities. When working capital of a company is positive, this means the company's current assets are greater than its current liabilities. The company has enough resources to cover its short-term debt and there is residual cash to run the operations. When working capital is negative, this means the company's current assets are not enough to pay for all its current liabilities. The company has more short-term debt than its short-term receivables and cash in hand. Negative working capital is an indicator of poor short-term health, low liquidity, potential problems in paying debt and obligations as and when they become due. It is worth noting that negative working capital is always not a bad thing. It can be a good or a bad depending on the specific business, its stage. However, prolonged negative working capital is not a good sign. Now let's understand what are the components of working capital. All components of working capital can be found on a company's balance sheet, though a company may not use all the elements of working capital discussed below. For example, a service company that does not carry inventory will simply not factor inventory into its working capital calculation. Now we'll understand the components of current assets and current liabilities. Current assets includes cash, accounts receivable, inventory, etc. to be liquidated or turned into cash in less than 1 year. Current liabilities includes accounts payable, wages, tax payable, and the current portion of long-term debt that is due for payment within 1 year. Now, let's understand limitations of working capital. Working capital can be very insightful to determine a company's short-term health. However, there are some downsides to the calculation that makes it misleading sometimes. Working capital fails to consider the specific types of underlying accounts. For example, imagine a company whose current assets are 100% in accounts receivable. Though the company may have positive working capital, its financial health depends on whether its customer will be able to pay and whether the business can come up with short-term cash. On a similar note, assets can quickly become devalued. Accounts receivable balances may lose value if a top customer doesn't make payment for apt reasons. Inventory is at risk of obsolescence. Physical cash is also at risk of theft. Therefore, a company's working capital may change simply based on forces outside of its control. Last, working capital assumes all debt obligations are known. In fast-paced businesses, agreements can be missed or invoices can be processed incorrectly. Working capital relies heavily on correct accounting practices, especially surrounding internal control and safeguarding of assets. Now let's understand calculation of working capital with an example. At the end of 2021, Microsoft reported $174.2 billion of current assets. This includes cash, cash equivalents, short-term investments, which are done for a period of 1 year, account receivables, again to be realized within 1 year, inventory, and other current assets. Now, the company also reported $77.5 billion of current liabilities, which comprised of accounts payable, current portion of long-term debts to be serviced within 1 year, accrued compensation, short-term income taxes to be paid within 1 year, short-term unearned revenue which is yet to be realized and will fall within a period of 1 year, and other current liabilities. Therefore, at the end of 2021, Microsoft's working capital metric was 96.7 billion US dollars. We arrived at this number by simply subtracting $77.5 billion of current liabilities from $174.2 billion of current assets. If Microsoft were to liquidate all short-term assets and extinguish all short-term debts, it would have almost $100 billion of cash remaining in hand. Another way to look at it is, if Microsoft working capital of $96.7 billion is greater than its current liabilities, therefore the company would be able to pay every single penny twice of what the debt they have. Is negative working capital always bad? It depends. It is bad if a company's current liabilities exceed current assets. This means the company doesn't have enough resources in the short term to pay off its debt, and it must get creative in finding a way to make sure it can pay its short-term liabilities in time. A short period of negative working capital may not be an issue depending on company's place in its business cycle, and if it is able to generate cash quickly to pay off debt. Instance where negative working capital will exist depends on nature of business, business cycle, stage at which company is operating, and couple of other factors. Early stage companies or those in growth phase might experience negative working capital due to high demand and rapid expansion. Companies with strong cash flows and ability to generate cash quickly can navigate negative working capital. Industries with long payment terms or seasonal fluctuation might experience temporarily negative working capital. Now let's understand how to improve working capital. First and foremost is to increase current assets by way of saving cash, build higher inventory, prepay expenses wherever one can enjoy cash discounts, extend credit wisely to reduce bad debts write-off. Second way is to reduce short-term debts, avoid unnecessary or expensive debt, negotiate the best credit terms available, be mindful of spending money with vendors or with staff. Additionally, optimize accounts receivable and payable, manage inventory efficiently, improve cash flows, consider factoring or invoice discounting. By implementing these small strategies, companies can improve their working capital, enhance liquidity, and maintain a healthy financial position. The crux is, working capital is an important metric that assesses a company's ability to pay its short-term debt and fund its current operation without external funding. It is calculated by dividing current assets by current liabilities. A few important points to remember. How to manage working capital. Working capital can be easily managed by monitoring a company's current assets and current liabilities to ensure efficient operations. One should regularly do an asset test ratio, which is a strong indicator of firm's ability to cover immediate liabilities. One should keep on monitoring liquidity ratios, which gives a fair sense on financial metrics that determine a company's ability to pay off current debt obligations. Cash ratio is an important measure for a company's ability to repay short-term debt using cash or cash equivalent. One should be mindful of long-term liabilities also, which are due in more than a year's time. Current assets, assets that can be converted into cash within 1 year. Hope this gives a fair idea on how to assess working capital and what are the important points to remember. Do follow us on social media for further updates and join our live session. Thank you.